Well, U.S. natural gas futures slipped modestly on Monday, weighed down by updated forecasts that offered little near-term support and kept traders reluctant to push prices higher. Even though the models continue to advertise colder conditions arriving in late November and expanding further into early December, the uncertainty surrounding the exact timing, and the sheer strength of current production, has repeatedly choked off any meaningful upside momentum. As a result, the market remains stuck in a holding pattern, waiting for a more decisive catalyst to break out of its recent range. Weather projections still call for below normal temperatures spreading into the west and northeast from November 26 to 30th, with colder air pushing into the central U.S. as December opens. Yet despite these signals, demand through the end of this week is expected to stay seasonally light. Traders are wary of jumping ahead of weather-driven demand that hasn't fully taken shape, especially given how often recent forecasts have struggled to lock in consistency. On the supply side, dry gas production remains the dominant force. Output climbed to 111.1 billion cubic feet per day on Friday, marking a sharp 7.9% increase from a year ago. The EIA has also bumped its 2025 production outlook to 107.7 billion cubic feet per day, reinforcing the narrative that supply remains more than adequate. LNG feed gas demand is holding firm at 17.7 billion cubic feet per day and power sector consumption is also inching higher, but these gains continue to be overshadowed by the relentless production strength. Until colder temperatures generate a more forceful heating load, the supply side retains the upper hand. In Monday's session, price action reflected this lack of conviction, with natural gas trading tightly between major daily technical levels. The market is pressing directly into resistance at $4.60, a key ceiling that has repeatedly halted bullish attempts. Just below, the 50% retracement level at $4.50 is acting as an intraday pivot, serving as the balance point for the day's rotation. Immediate support stands at $4.45, with a secondary layer at $4.40. A deeper slide would bring the 50-day moving average into play at $4.08, providing additional structural support. With futures currently boxed in between the $4.60 and $4.40 levels, the technical picture suggests a deliberate pause, an indecisive stretch of consolidation as traders wait for fresh information strong enough to tilt the balance and ignite a more directional move. Don't forget to drop a comment, hit that like button and support the channel. See you in the next one.